All right, Chapter 3, in the most exciting course you'll take at Harding University, commercial banking. All right, how is the banking industry set up? All right, so what do banks do? They supply credit, okay? They loan money to people, and they provide payment services, which is the transfer of money from party A to party B. That's what a payment service is. To businesses and to households. That used to mean checks, checking. Okay, you'd go to a retailer and you'd write a check and give it to the retailer to pay for what you were buying, and the banks made sure that your money was moved from your checking account into the bank's account. Payment services. Okay, now that's all done online automatically with the debit cards and credit cards. Very few banks. Very few people use checks anymore. Okay, so banking assets have become increasingly concentrated in the very largest firms, and that's a good thing from the standpoint of efficiency, but it is a bad thing from the standpoint of a bank knowing who you are. Banks have gotten bigger and bigger and less personal. Okay? And also it's a bad thing for capitalism because there's less competition, and less competition means more oligopoly, and more oligopoly means that firms can push you around. Competition keeps businesses honest, okay? And it keeps businesses productive, all right? And it's also a bad thing from a capitalism standpoint, because you become too big to fail. If your bank is too big, if your bank fails, it will decimate the entire economy. And so getting too large is a real problem. It's a problem. All right. Just 3 banks, Citigroup, JP Morgan, and Bank of America, hold 48% of total industry assets. 3 banks have 50% of the total amount of money held in the banking industry, and we know that the banking industry holds like 25% of all the worth, all the value of Americans. So that is a whole lot in 3 companies. There are a lot of small banks in the United States. We see them here in Searcy, okay? And these smallest banks make up 37% of the total number of banks, banking companies, okay? 37% of banking companies, okay, but only 1% of total assets. So there are a lot of small community banks around, and they're important because they loan to people in the community. They're more focused on economic development in your community than the big banks are, okay? All right, so here's a look-see at the assets held by the banks. So medium-sized banks, about 9%, and the small banks around 1%, and the big banks of 89%. So that's, of course, the big banks here, the money center banks, that's a bigger group than just 3. But the big money center banks completely dominate the industry in terms of the deposits they hold and the assets they hold. All right, so here's the number of banking companies out there, okay? So the medium-sized banks, like the Regions banks and Simmons Bank, about 56% of the banking world in terms of the number of companies. And then the largest banks, about 8% in terms of the companies that are out there. And then the smaller banks, which would be like a First Security, about 37%. Okay, so the smaller banks hold 1% of the assets and 37% of the banks out there. That's a pretty disproportionate. Now, First Security is a smaller bank in terms of the number of branches they have, and it's just one company, but it's a pretty large operation, but it's only in Arkansas. That is by choice. They could have gone the route of Simmons Bank, which was, and Simmons Bank used to be an Arkansas bank, and now they're a regional bank. What did they do? They're publicly traded, and they started issuing stock and buying other banking companies in other states to grow. And Rennie Rutledge, who owns First Security Bank, said, no, I don't want to do that. I'm not interested in doing that. I want to grow my bank in Arkansas and just stay in Arkansas. Okay, he lives in Searcy, and I see him every afternoon. Every time I've ever gone out to Searcy Country Club, he's out there playing golf at 6 o'clock in the afternoon. But he's also in his office every morning at 6 o'clock in the morning, even though he's a billionaire. He's still at his office every morning at 6 o'clock. All right, he's got 3 sons that are stepping in and moving up in the bank. They're going to take the bank over. All right, so so what you can see on the left is back in '91, the market share of mid and small banks compared to the large banks, and then over here on the far right, you can see how the assets at large banks have continued to grow, and the assets at small banks have lost a lot of market share to the big banks. Okay, so that's what's happening in the industry. All right, so there's a lot of discrepancy, and the way a bank, how large a bank is, affects how the bank is organized and what kind of services they offer. Okay, so we're going to take a look at what a typical money center bank looks like and what a typical community bank looks like. Okay, so we have the money center bank, the national bank, regional bank, and community banks. Okay, and so banks start here, and they used to grow internally, but now the regional banks buy the community banks, or the community banks merge so that they become regional banks. And then the regional banks merge, or the national banks buy them so that they can become national banks. And then they become national banks, and they are purchased by the money center banks. Okay? A lot of consolidation. And when these guys come in and buy the community banks, okay, then new community banks are formed to fill the void left, because Regions Bank used to be, it started off being First National Bank and then Community National Bank. And First National Bank and Community National Bank merged, and they became First Commercial Bank. And then First Commercial Bank was purchased by Regions Bank, which is now a regional bank. And if you want to get a loan at Regions Bank, that decision is made in Birmingham. Okay? If you want to get a loan, a reasonably sized loan at Simmons Bank, it's made by Reese Jones here in Searcy. Okay? But at some point, that's going to be taken away from him, and the people, wherever their headquarters is going to be, right now it's in Little Rock, they're going to make the decision. And so the banks realize when they become regional, they no longer serve the community as well as they used to, and people in the community get together and they form their own community bank, which then grows, which is then purchased again by the regional banks. And that's what happens over and over. It's a cycle. And I know of people that have started banks, and in Arkansas, the law says that if you start a bank, if we give you a bank charter, you can't sell your bank stock for 5 years. I can't tell you how many times on the first day of the 6th year the bank is sold. And that was the plan all along. To start the bank, to build the bank, so that you can then sell the bank. And maybe even do it again. That's how Bank of the Ozarks started. All right. So the money center banks are the larger banks, and they have some important advantages over the community banks. Okay? All right. First, they are diversified. They're diversified across economies. They're diversified geographically. Like I said the other day when we were talking about the Federal Reserve, you've got 12 districts. And each area, each district has a very different looking economy. And banks are dependent on economic activity in their area. If the economy in their area is strong, banks will be prosperous and successful. But if the economy turns down, the bank's business is going to turn down. So if you can spread out geographically, then you can dampen the volatility and your exposure to one geographic economy, one area. And also by product line. The larger you get, the more services you can offer. And the more services you can offer, the more stable your earnings will be. If all you do is mortgage lending and the mortgage market in your area slows down, you're in trouble. So if you also sell insurance, you might be able to increase your life insurance business at a time when your mortgage business is slow. It stabilizes. It's safer. All right. So you withstand the risk of that fluctuating economy in your area when you can diversify. All right. The bigger companies are able to raise more capital. Okay. People feel more comfortable buying bonds and stock from larger, stronger organizations. Okay, it's kind of like Nick Saban, you know, once you go to the playoffs one time, the college football playoffs one time, kind of like Dabo Swinney, all of a sudden, all the top prospects want to go to that school. Nick walks in and says, we're gonna go 11-0, and we're gonna go to the national championship. And you're the best tight end in the country, and we want you. So you can go to my alma mater, you can go to South Carolina. Good luck with that. Okay, you're going to go 3-8 every year, all right? Or you can come to Alabama, and you can be wearing that national championship ring. And by the way, we're going to have the best quarterback in college football who's going to throw the football to you. And by the way, I used to coach in the NFL, and I know a lot of NFL folks, and your chances of going to the league are going to skyrocket if you go with me. So it's self-fulfilling. It's self-fulfilling. I went to South Carolina, and our big rival was Clemson. They're 2 hours up the road. And I couldn't believe, and I've seen this and read this, the number of students who are not athletes who want to go to Clemson because Clemson has won a national championship. Like, are you kidding me? People are basing their college choice, their college decision on the fact that a school has a good football team? Really? I think that's nuts. All right. So you can raise a lot of capital. Self-fulfilling. All right. You got a lot of money to spend, big numbers. You can go out there and hire the best people. It's self-fulfilling. Okay, now those are people that want to live in those areas, by the way. I don't. Who's been to New York City? Okay? Who wants to live in New York City? Go ahead, Court. You can raise your hand if you want. I've been to New York City several times. When I was in your seat, actually in graduate school, I had a dream. My dream was to be an analyst at a Wall Street firm. That's what I wanted to do. I wasn't well connected. I went to University of South Carolina. I didn't go to a top 5 school, and I wasn't able to get a job on Wall Street. I got a job at a regional firm in Little Rock, and within the first 3 months, they sent me up there for a week. Man, about 2 days was enough for me. When I visited those people in their crowded offices with files from the floor to the ceiling, and they were getting in their offices at 6 o'clock in the morning, and they were going home at midnight, I said, God, thank you for keeping me out of this. You know, if you've ridden the subway, the first time it's kind of cool, and after that, it's kind of creepy. When you're body to body with people like, you know, and I don't know, man. It's a great place to visit. All those bigger cities they offer so much. There's so many things you can do. It's incredible how much they offer. But is that where you want to live every day and raise your family? And it can be done. And you don't have to live in the city, you know, that you go out an hour or two and it's gorgeous, beautiful. Anybody been to Philadelphia? Man, Philadelphia. Outside of Philadelphia, Valley Forge and all those areas, it's green. It's fantastic. It's beautiful. Every bit is probably prettier than Arkansas. So you don't have to live in the city, but you're going to have to commute. And it's really, really expensive, and I don't know, man. All right. So their size enables them to spread the cost of doing business. So what does that mean? Okay. That means that the cost of compliance, which is a huge cost, the cost of your computer systems, the cost of your employees, they are smaller as a percentage of your revenues. You can spread the cost of business over larger revenues, and you can make a higher profit margin. Okay, that's what that means. Whoops, sorry. There you go. There you go. Economies of scale. That's what economies of scale are. Improving your margin by spreading your costs over more unit sales. Okay? Now your fixed costs are higher, okay, on an absolute basis, but as a percentage of your revenue, they're much smaller. So if you have to make an investment in computer systems, if you have to give people raises, if you have to hire more people to do compliance, it doesn't bother you. But when you're a smaller firm, okay, and new regulations come into play, it can put you out of business. But it won't do that for a larger firm. All right, so these are the typical departments at a money center bank, and let's look at some things that are kind of unique. Okay, how about portfolio management, wealth management? This is not done at smaller banks. Okay, how about making markets in stocks and bonds? You got to have a lot of capital to do that, and you have to be able to attract top talent to do that. Smaller banks don't do that. Okay. International banking. You know, I don't think Simmons gets involved with international banking. I don't think you can do international banking at First Security. I don't think you can do it at Regions. You got to go to Little Rock and go to Bank of America. All right, commercial credit, that is loaning to businesses. And I'm not talking about 50,000. I'm talking about $1 billion or $2 billion or $5 billion. You go to First Security with a great plan. Let's say you got a big business and you want to make an acquisition. You say, I need $1 billion of financing. Not from them. You got to go to a money center bank for that. All right, they're involved in big commercial real estate, owning it and operating it and lending to it. Okay. How about credit and debit cards? The biggest issuers of credit cards and debit cards are the money center banks. Okay? The computer system that you have to manage this process is huge, very expensive. Now, there are firms out there that provide that service to the banks. That's a good thing. All right, now let's look at the community banks. Very few layers between top management and the staff. Okay? They're not nearly as bureaucratic, which means they can make decisions and change their strategies very quickly. Okay? So I think I mentioned to you Ford versus Ferrari. Did we talk about that? And that's what I'm talking about. The guy goes in and he's waiting for Mr. Ford, and he sees a folder changing hands 4 times before it makes it to Mr. Ford. And he says, I bet that folder changed hands more than 4 times. I bet that folder changed hands probably 30 or 40 times before it finally made it to you. You can't get anything done. It takes so long to get something done at these big bureaucratic companies. Okay? So the community banks are very affected by the local market. All right? So the 2 biggest employers now left in Searcy are Harding and the hospital. And that used to not be the case, man. Not too long ago, we had some big employers in Searcy. A lot of manufacturing happened in Searcy. We had a Kohler plant where Fellowship Bible is going in. That was a huge Kohler plant. What does Kohler make? They make bathroom fixtures, okay? We had Whirlpool. Whirlpool makes washers and dryers. We had ITT. They make communications equipment. Oh man, who else? We've lost tons of big business, and they've gone outside the country. Okay, lower costs. So the banks, the local banks, have been hurt. Also, what's another area where the banks loan a lot of money into in Arkansas? Agriculture. Agriculture. Okay. All right. Regulatory changes. If you don't have a lot of revenue and you have to hire somebody at $100,000, $150,000 a year to do compliance, okay, or a staff to do compliance, it's really going to hit your income statement hard, okay? So compliance tends to cost more as a percentage of revenues. So the small firms complain every time there are rule changes. What they say is, these rule changes hurt us a whole lot more than they hurt the big boys. And they're right. And there is an association of community banks, all right, and they lobby Washington. They actually compete against the money center banks. They say, don't make us follow the same rules the money center banks have to follow. So the rule of thumb is when a bank hits $10 billion, that's when there's a big jump in compliance costs. So you grow as fast as you can to get to 10 billion. You stop just short of 10 billion, and once you're ready to grow over 10 billion, you've got to get to 11, 12, 13 billion really fast, otherwise your profit margins get hit hard because of compliance. How large you are determines what your compliance is going to be. Okay? All right, so you can see that the number of community banks really got hit hard. Okay? Really got hit hard. A lot of consolidation. And it had to do with compliance and the services that were offered and the ability to compete. Oops, sorry. All right, let's take a look. All right, so this is what a typical community bank looks like. Okay? So you got your commercial loan officers, and they're going to be loaning money to small and mid-sized businesses. They're not making billion-dollar loans, and they're not making million-dollar loans. Okay? They're making $50,000 loans and $100,000 loans. Then you got the consumer loan offices. And who are they lending to? Mortgages, people who want to buy houses, cars, boats, education. Okay? So you got your business lenders and your consumer lenders. And I'll bet you at most community banks, it's the same people. Okay? You're a lender, and you're going to loan to a business, and you're going to loan to the guy who comes in and says, I want to buy a car. Okay? Then you have the business functions that every business has to have, your accounting and so forth, and your marketing. And your tellers, who are the main contact that people have with the bank. Okay? And they also happen to be the lowest paid people at the bank. All right, marketing and advertising. All right. Okay, so let's go over slide